Welcome to a playful journey through India's economic landscape as of January 2026. We'll explore key reforms in tax, indirect tax, fiscal discipline, and sector specific initiatives. Think of it as a vibrant roadmap towards a stronger, more business friendly India. We'll use real person interviews and exciting visuals to keep things engaging. Tax reforms are all about making things simpler, fairer, and more predictable. The goal is to attract investment and reduce legal battles. Those pesky legal battles. Key developments include extending the direct tax Vivad se Vishwas scheme, which has already resolved over 1 lakh cases. Also, keep an eye out for the optional presumptive tax regime for foreign entities in digital services, potentially boosting FDI by 15 to 20%. This regime can boost FDI inflows, as seen in recent growth trends. Indirect taxes like GST and customs are also getting a makeover. A one-time dispute resolution scheme under customs law is on the horizon, aiming to settle pending cases. Plus, expect reforms in GST input tax credit (ITC) rules to reduce working capital needs for businesses. Tax holidays for IFSC units like those in Gift City are being extended to 2030, attracting major investments. Fiscal discipline is crucial for sustainable growth. It ensures the government spends responsibly, balancing budget deficits with economic development. The fiscal deficit represents the gap between government revenue and spending, capped at 4.4% of GDP. The government met this target at 4.3% in FY25 and plans to maintain it for FY26 despite economic challenges. The strategy involves smart spending management with high capital expenditure focused on productive assets. CapEx reached 11.5 lakh crore in FY25, up 25% year over year, supporting infrastructure like roads and railways. These investments create long-term economic benefits through job creation and growth. Projects like highways improve connectivity, leading to higher incomes, better health and education, and overall improved quality of life, forming a positive cycle of development. India is focusing on targeted incentives to boost specific sectors. For research and development, the government offers 200% tax deductions for startups under the Startup India scheme. This encourages innovation and attracts investment in technology and new ventures. In healthcare, the Ayushman Bharat initiative includes digital health skilling programs that have trained 5 lakh workers by 2025. This enhances healthcare access and adoption, with digital health usage up 40% in recent years. Defense spending has increased 10% to 6 lakh crore, representing 2.2% of GDP. This supports national security through initiatives like indigenous missile systems from DRDO, which have saved Rs 10,000 crore in imports. The rising trend is shown in this budget graph. Infrastructure development targets Rs 12 lakh crore in capital expenditure, focusing on border infrastructure like roads, strategic railways, and advanced landing grounds. This map shows key projects along India's borders, enhancing connectivity and security. Overall, these targeted boosts in research and development, healthcare, defense, and infrastructure are designed to drive economic growth and resilience in key areas. Tax reforms are designed to create a predictable policy roadmap that gives businesses clear guidance on tax expectations. This reduces uncertainty and allows companies to plan their operations more effectively. Businesses can now opt for an optional presumptive tax regime specifically for foreign entities operating in sectors like digital services and consultancy. This regime allows companies to pay tax based on estimated revenue rather than complex actual profits, simplifying compliance. These reforms lead to several important benefits. First, there's less litigation and tax disputes, as the simplified rules reduce opportunities for disagreements between businesses and tax authorities. The reforms also boost business confidence, as companies can now operate with greater certainty about their tax obligations. This attracts more foreign investment, as seen in the upward trends in India's FDI over recent years. Finally, these tax reforms contribute to an overall improvement in India's ease of doing business, making the country more attractive for both domestic and international companies to invest and grow. Indirect tax changes in India are creating significant positive impacts for businesses, making operations easier and attracting more investment through several key reforms. The one-time dispute resolution scheme under customs law, launched in January 2026, helps businesses by settling over 200,000 pending cases, with penalty waivers up to 70%. This reduces costly litigation and speeds up resolutions. Reforms in GST input tax credit rules, introduced in the 2025 budget, allow instant credit claims through the GST portal. This significantly reduces working capital requirements and improves cash flow for businesses. Extended tax holidays for International Financial Services Center units, now till 2030, provide exemptions on services income. This attracts more investments and boosts the financial services sector. Together, these indirect tax changes lead to reduced working capital needs, easier business operations, and more investment flowing into India, supporting overall economic growth. India's economic reforms paint a picture of a nation striving for greater efficiency, transparency, and growth. These initiatives build a more resilient and attractive investment destination despite global uncertainties. Tax reforms will advance digital compliance using AI-driven tools, potentially reducing errors by 40% and leading to a unified tax code. The tax-to-GDP ratio aims to reach 18 to 20% by fiscal year 2030. Indirect tax changes will include GST rate rationalization and integration with global standards supported by digitization handling 1.5 crore daily transactions. Fiscal discipline will maintain deficits at 4 to 4.5% while increasing capital expenditure, with CapEx share in GDP at 3.5% and rising 25% year over year. Sector-specific initiatives will drive AI-driven R&D, sustainable infrastructure, potentially increasing sector contributions to GDP by 5 to 7% and yielding $100 billion in exports by 2030. While global uncertainties like inflation and supply chain disruptions persist, these strategic initiatives aim to build a more resilient and attractive investment destination. Keep an eye on these developments as India continues its journey towards economic prosperity.